CVS Health is down 26% year to date, currently offers a yield of 3.52%. But is it a stock we should be buying now? Should we be waiting or should we be selling? We're going to find the answers to that in today's episode. We're going to take a look at the historical performance of the stock. We're going to jump into their income statement, look at their revenues, their bottom line net income, take a look at that balance sheet, their cash versus their total debt. We're going to take a look at that dividend safety score. We're going to take a look at some very important financial metrics around the total debt and their free cash flows. As always, we're going to end the episode with our stock valuation model, getting to our intrinsic value and finding out what our acceptable buy price would be with our margin of safety. So year to date, it's down 26%. And for shareholders who have been holding CVS over the last 10 years, have had gains of around 16%, which is fairly poor, even considering it does not take into account reinvestment of that dividend. Now, it's poor. Obviously, it does depend at which point you did buy the share. And as we have noted, it is trading at that 52-week low. Now, in terms of their financials, their income statements, typically with revenues, we like to see around 3 to 7% increases year on year for these type of companies. Now, taking a look, CVS in December 2018 reported revenues of 193.9 billion. And what we can see here is, in actual fact, very nice growth year on year. 5 years after the 193 billion was reported, they made revenues of 321.6 billion. So very nice growth. I do really like that. And what I want to see is that mirrored at that bottom line, that net income line. Now, December 2018, they made a loss of just under 600 million. But what is good to see is that 5 years later, they did make and report a 4.1 billion net income. So we can see here they did increase from December 2018 to 19, but we can see also a massive drop from December 21 to December 2022. So we do want to kind of understand that when we look at our financial metrics later on. Now, it's good to see a nice net income bottom line. It's also good to see those increases in revenues year on year. Now, what I want to see is how the cash looks compared to that total debt. So, December 2018, 4 billion worth of cash. Their latest quarterly report, 14.6 billion. So, in my opinion, this is very, very nice to see. Over the last 5 years, they have been accumulating that cash, and there is a nice chunk in their balance sheet currently sitting at 14.6 billion. Now, how does that compare to the total debt? So, we can see here their total debt reported in 2018 was around 73.4 billion. And in their latest quarterly report, just over 5 years later, is relatively flat, a very small increase to 76.5 billion. So, very nice to see, even though their debt has remained relatively flat over the last 5 years. What is good to see is that their cash balance here has been accumulating from 4 billion to 14.6 billion. Now, this still raises questions that we're going to find the answers to around their debt levels, the interest they're paying off, and that dividend safety. Now, we have a dividend safety score of 90, making it very safe, and a market cap of 88.2 billion, making it a large cap company. Now, some key metrics to point out here, of which we will dive deeper into some of these. They have been paying dividends without a reduction over the last 26 years. Now, some very positive recession key metrics. They did in the last recession, 2007 to 2009, increase their dividends. So positive if you believe we're heading into a recession. Recession sales are negative 2.5%. This was above the average growth during that period. And even though they had negative return of negative 38% in that previous recession, it did beat the S&P 500 to negative 55%. So all positive signs in terms of if you believe you are heading into a recession. But as always, historic data does not mean this is going to be repeated in the future, but is a positive sign nonetheless. Now, you hear me say it many times. You want at least 4% increases in your dividends, in your salary, in other income producing assets, because the US inflation rate over the last 40 years was 4%. So if you're getting less, you are effectively losing your purchasing power. Now, their latest increase was very nice to see at 10% in December 2022. However, below inflation increases over the last 5 years. But if you have been holding the company for over the last 20 years, you have been receiving an average compounded dividend growth increase of 16% year on year, which I'm sure beats any increases in your salary or maybe in the majority of your other dividends in your portfolio. Dividend growth streak, so they have had 1 year of consecutive increases, as we'll find out in the dividend discount model shortly. They have remained relatively flat over the last few years. However, they have been paying a dividend for the last 26 years without any reductions. Now, dividend yield theory states that the company is undervalued when the yield is sitting above the 5-year average, as we can see here. So this is one sign of undervaluation. Likewise, when the forward PE is sitting below the 5-year average is another sign of undervaluation. And another sign of undervaluation is when the PE ratio is below the sector PE, as we can see here. Now, 3 ticks for undervaluation here, but we never look at any of these models in isolation, and we will draw our conclusion at the end of the video once we have run through our stock valuation model. Now, the 52-week price range is currently sitting right at that 52-week low, but as I always say in my videos, it does not mean it's undervalued purely based on the fact that it's at the 52-week low. Likewise, if it was at the 52-week high, it does not mean it is overvalued. Earnings payout ratio, free cash flow payout ratio. If you've seen my videos consistently, you'll know that we don't tend to look at the earnings as it is susceptible to manipulation through accounting. We prefer to look at the free cash flow. However, for those investors who do like to use that, and I know there are many, I've kept this on screen. For both, I personally like to see below 60%, as that's the sweet spot. It means there's room to continually grow that dividend. Double digits is preferable. And we can see across the board below 60%. In the last couple of years, even below 20%. 2023 expected around 29% and 28% for the earnings. So very positive to see in my opinion. Now, earnings per share, likewise, I do prefer to look at the free cash flow per share, but in my opinion, they do mirror essentially the same. $4 in 2013, $8.69 in 2022 with a slight dip in 2023. Likewise, $3.12, $10.30 in 22, so a nice increase with 2023 a slight dip. Now, I always say we like to look at least 10 years because if we were to look at, say, only 2 years or if we look at 4 years here, we wouldn't see much movement. But at least 10 years gives me a good sense of reliability in the information and the business, and it gives me a good idea of how the business tends to perform. So even though we do see drops here into 2023, I'm not too worried, as I would expect 24, 25 for it to start to pick up again. So very positive so far for CVS. Now, sales growth 3 to 7%, as I mentioned earlier, and there has been some very nice growth. We can see here well above 3% and even some years well above 7%. Now, this is very, very positive, is what I like to see. Nearly 3 times their revenue over the last 10 years, from $127 billion in 2013 to $322 billion in 2022. Very nice, and it's got that very nice upwards trajectory. So very positive to see. Shares outstanding, you know we love it when companies do share buybacks and return excess cash to us shareholders. When it's the opposite, they're essentially diluting your shareholder ownership. Now, there was a period when they did share buybacks. They then did issue shares, but for the last 4 to 5 years, it has remained relatively flat. So not too much to discuss there. If you've not seen my video that I've pinned to the channel, do go check that out, as I do discuss my 7 golden dividend metrics for essentially finding perfect stocks, and there are some examples in that video. The reason why I'm mentioning it is because return on invested capital is one of the 7 golden dividend metrics. We want a minimum of 10% is what I like to personally see in terms of having faith in management and their capital allocation. We can see here it has dipped slightly from 2013 to 17, but it has started to pick up. And if I do continually see this around 10% or more, then this does instill faith in management. And right now, I'm not too concerned, but we'll start to take a look at this over the next annual report. Operating margin and free cash flow margin is where this company may start to slightly fall down. We can see here that their operating margins are below 10%, which is what we prefer. However, given the fact that they have maintained 5 to 6% over the last 10 years and they have produced the results we have mentioned in our financial metrics, for me, I am okay with this, but I would not like to see this slip any further, and that would be when I would be concerned. Likewise, with the free cash flow margin, if they can maintain it around 5 to 6%, 6% is our ideal. But if they can maintain it around 5 to 6%, which is what they have done over the last 10 years, then again, I won't be too concerned. But these are metrics that I will look at in the next report just to make sure that they do stay within the area we like to see them at. Now, I did mention their high debt levels. However, it was relatively flat over the period. What we like to see is below 3 for their net debt to earnings before interest, tax, depreciation, and amortization. Essentially saying in 2022, it would take CVS Health 2.38 years to pay off all of its debt, net cash on hand. So we can see here over the last few years, it has been below 3 and is expected in 2023 to be around 2.54. Again, there have been some years likewise where it has creeped above that. So again, this is something that I would monitor. But one thing that I am positive about is the way they have managed to accumulate cash over the last 5 years. Again, net debt to capital, we can see here over the last 10 years, it has been around that 0.5, which is our preference for consumer retailers. What this essentially says is 44% of the company's financing was from debt as opposed to equity. Now, onto the stock valuation model. So far, I'm actually very keen and very positive with CVS in terms of what we've seen. There are a few things where I would note in their next annual report and quarterly report, but so far, so good. Now, do smash that like button if you are enjoying the content. If you are finding this is providing value, do let me know your thoughts in the comments, and do hit that subscribe button if you would essentially like to have more content coming your way. Now, if you do want to grab a copy of this, do check the pinned comment where you can pick up a stock valuation model, essentially create your own and find out the values of your own portfolio. And do join us over at Patreon, again, link in the description, with lots of added benefits. Now, jumping straight into Graham's valuation model, we have the earnings per share. We have quite a high growth rate as expected by analyst estimates, and we have our current yield on AAA corporate bonds. Now, the intrinsic value based on Graham's valuation is coming at $81.24, showing some nice upside to the current share price and just below that 52-week high. Now, multiples valuation model, we have companies in a similar industry and size. We have DGX, Quest Diagnostics, Laboratory Corp, and Charles River Laboratories. Once we put in our stock price in EPS, we have our multiples, which we multiply by the average PE. This gives a stock price for CVS at $64.50, slightly lower than the current trading price. Now, the dividend discount model, as I mentioned earlier, there were a few years where they had kept that dividend constant at 2. They then, the last couple of years, have been increasing it by around 10%. So we see an average growth rate of 4%. If you remember, that is in line with inflation. I'm expecting over the course of the next few years for that to increase and to hit around 5%, slightly higher than inflation. And I believe that they may be able to turn this around, and therefore I've gone for 5%. DDM price therefore comes out at $84.70, again showing some undervaluation to the current share price and below that 52-week high. Now, the final model, the discounted cash flow model, we have our free cash flows year on year with the growth. Average growth rate at 17.7%. I've gone for a growth rate slightly below analyst estimates of 4%, and therefore this is on the more conservative side. We have our free cash flows year on year. Using our discount rate, we get the present value of these future free cash flows alongside that terminal value. Once we add this together with the cash and subtract the total debt, we get the equity value, which we divide over the shares outstanding to get the DCF price of just under $130, showing some nice upside to the current share price. As always, do double smash that like button if you are enjoying the content, and do hit that subscribe to get notified when new videos are being released. The intrinsic value is essentially the average of these 4 models that we have just run through, coming at $90.30, showing some nice upside to the current share price. Now, margin of safety, typically for companies with strong moats, previous good historical financial metrics, and some nice guidance going forwards, I would go for around 10%. However, for CVS, you could argue a margin of safety of around 20%. Now, for those who are looking for a margin of safety of 10%, it would show that it is currently a buy at $81. Now, for people who have a margin of safety of 20%, like me for CVS, again, it is still a buy up to $72, so there is room to be buying with a margin of safety of 20%. Now, Wall Street forecasts the price over the next 12 months to essentially go up to $95.94, which is also higher than our intrinsic value. So they do believe there is some nice upside to the current share price. As always, let me know your thoughts in the comments. Let me know if you're a shareholder, if you're thinking about buying, or if you're on the sidelines. And as always, have a great day and catch you on the next episode. Take care.